All right, we are back for another Friday financial wrap up with Mr. Michael Zuber. How are you, Michael?
I'm doing great, man. How are you?
I'm doing well. How was your 4th of July?
It was good, uneventful. We don't do a lot. We used to go see fireworks, but now we're just old, crotchety people, so we stay home.
Yeah, say similar. We did fireworks, not the big city ones, but local around my in law's neighborhood. It was fun. Today is for July the 7th, 2023. Let's get right into it. Man, what a wild ride. We're at the mid year ADP payroll report. Explain why it's important and what happened this week.
Yeah, so the jobs market is obviously up until now been very strong. Some would argue that Jerome Powell is fixated on the job market is it is quote unquote too strong, and he's afraid that wage inflation is going to run away and we're going to have sticky inflation for a long time. So everybody should know we've raised rates 500 basis points. There's lots of talk about a July rate increase, higher for longer, all of these things going on. So when we get a report like ADP, which ADP is a monthly report, so we get one cut of it a month, it looks back at the previous month and we're trying to see how many jobs we created, or frankly, how many jobs we lost. The jobs report that we got this week was expected to be 220,000. That was expected to be down from the month before, which was 267. So generally speaking, the experts are saying, Jerome Powell and the Fed, you're doing your job. You're slowing the economy down. You've done enough. That's really what they were hoping for, is you've done enough. Lo and behold, we got a jobs report that said 497,000.
Wow.
So it was a double, a double. So what does that mean? Well, maybe Jerome Powell and the Fed haven't done enough. Maybe we have to go higher. Interest rates are clearly going to react higher based on that number. The expectations of the Fed raising are going to go higher. The hope that the Fed would cut this year will disappear. It's rates are going up. That's the net of this.
Now, just what are your thoughts on okay, how do they miss? I mean, I can see okay, they project somewhere mid 200s, low 200s, they miss by 20%,
Sure.
30%. Just any thoughts on explanation? How did they miss by such a huge? I mean,
Yeah,
it was double.
it was a double. I think there's a couple of things that are happening structurally in the economy. And when it's structural, the experts don't look at it. Because again, you got to remember these experts have PhDs in economics. They live inside spreadsheets. They're not in the real world, as I like to say. That's just who they are, and it's okay. I think there's a couple of structural things that we've talked about on my channel. One is we've moved away from stuff to services.
Yep.
So what might that look like? Well, you can go back to the ADP report. What is stuff? Manufacturing. We saw manufacturing mean negative 42,000. We're not making as much stuff. We lost 42,000 people. Services, hotels, travel, food, up 232,000. That by itself beat the expectation. And then last week we talked about new home sales. Construction tie is up 90,000.
Wow.
So new home construction is moving, and it's obviously because they have flexibility with rate. They're building smaller homes. They're doing a lot of right things. But yeah, I think it was a structural change from stuff to services that they missed. I heard from the CEO of the largest restaurant in hotel chain, the hotel, a billionaire Barry. He said he had a backlog of like 30,000 open recs for his hotels. And now he's starting to get applicants. People are starting to fill them out. So I think there was just a structural delta that they missed, is my best guess.
Interesting. Very interesting. Well, let's continue. Let's talk about the Fed meeting. Fed meeting minutes. What are your thoughts? What happened this week there? And just what are your thoughts there?
Yeah, so the Fed meeting minutes came out on Wednesday. What are they're essentially a summary of what happened 45 days ago. And we learned a couple of things. Uh, First, we figured out of the 18 representatives, how many want to pause, how many want one, and how many more than one rate increase this year. The answer was, again, this is as of 45 days ago, two of 18 wanted a pause. 12 wanted two or more. So what does that mean? Four wanted one more rate hike. So 16 of the 18 see at least one more rate hike coming. I believe the odds of a July rate hike have to be over 95% now. I am standing on such a small island by myself now. It's getting awful lonely because I still think there's a sliver of a chance there is no rate increase. But dude, after the jobs number, not feeling very good. But again, we'll see. I'm not going to change my opinion this close. I think that's not intellectually honest. If I'm wrong, I'll just admit it. I'm not unlike all the other experts who never want to be wrong. I don't care if I'm wrong. I take a shot and live with it. But yeah, the Fed meeting. Oh, and the last thing, 0 of the 18 said we'll have a rate cut this year. So higher for longer.
Well, and a couple things. I'm with you, right? So I'm following you every day on daily news. We do this show together. And I've got to say, I really was anticipating and thinking, okay, we hit terminal rate. We're going to see margin compression, which means 30-year mortgage begins to soften. And, and again, maybe we start to see some of the pent up, some of the locked up inventory start to unwind and start to see the market, real estate market, specifically residential housing, move toward normal. Obviously, that, and we'll conclude on that thought, but it feels as though we're going to see 25 basis points in this month.
Yeah, I mean, I'm not calling it just because I don't want to change this close, but 95% of the people agree with you.
Yeah, so we're going to see 25 basis points. And like you said, and this is something you have been true to. You didn't think that at any point we're going to start to see the Fed soften and knock down.
Oh,
you just saw it flat.
I'm not one of those people that said we're going to get a Fed rate cut. I did not see how that would be possible. So at least I got that part of the equation okay.
The only way too that even if the Fed pauses, then what we were anticipating and what I kind of picked up from you is that 30-year mortgage would soften because of margin compression.
Yeah, we have to get to the terminal rate before banks can compress the margin. As long as there's uncertainty about the Fed going higher, the banks are going to keep this margin excessively wide. And we're over 300 basis points.
Yeah.
Right. I think the last time I checked, it was 323 basis points. So yeah, but that won't compress until most people think we're at terminal rate. And right now, with that crazy jobs number, my guess is more people think 2 rate crises are coming. So again, that margin's going to stay fat.
Interesting. And you know what? We'll debate that a little bit toward the end at the end of this show. So let's go to the next topic, which is the slow season.
Yeah.
What is the slow season, Michael? And explain that to the viewer.
Yeah. So if you look at housing, it really, simply speaking, there's before June 30th and after June 30th. I want to give the folks at Altos Research a shout out. The data comes from them, Mike Simonson and that entire team at Altos Research. But basically, after June 30th, the market slows down. What is that going to? So again, the market historically slows down. We are at least entering this season with rising rates. We're on our third round trip of 7% and probably going higher. So what might we see? I think the first thing we're going to see is days on market are going to explode higher.
Yep.
I think that's coming. The next thing we have to watch is new listings. I have a sneaky suspicion that new listings are not coming. Thus, active inventory, it's going to crawl higher or lower. It's going to be a struggle. But at the end of the day, days on market going higher is a good thing, in my opinion. But we'll talk about that as we wrap this up. But yeah, the slow season, higher. This is exactly what happened last year. Last year, right at the end of summer, rates exploded to 7% for the first time, crushed the market, standstill, demand disappeared. We now know that 7% is this psychological number. We're here for the third time. But it's the slow season, so it's going to be interesting.
Very interesting time. Let me ask you, do you think we go to 7.5? It feels like it. Like,
yeah, I will say this. I think the last 52 weeks, the high is 7.37.
Yep.
I think we break that. I think we
I
break that.
I looked at that too. I did see that as well.
Where's the
Uh,
high?
right. I thought we were at the high today, but in fact it was yeah. So it's interesting that there was also something too that was splashed around since we're talking about this. I feel like it was on CNBC and you talked about it on the daily financial news in the last week, 10 days, where somebody had projected 8%,
Yeah.
8% 30-year mortgage rates. I mean, it feels like, and again, I'm not a fear guy, but we just call it like we see it. Is it
Yeah.
possible? Do we
No.
see 8%? Is that possible?
Yeah, so it's absolutely possible. I'm not sure it's probable. If I
Okay.
were going to put odds on 8%, again, we're talking owner occ, best credit, 20% down, right? 8%, we're already there for investors. So let's just get it clear. We're there for investors.
Yep.
Um, oh, I don't know. Odds on 8%, 30-year money. Let's call it 25%.
Okay. Well, that's good. I like that. I like it because I don't want to see 8%. I feel like I know realtors right now, with real estate loan people, realtors, we want to see the market move toward a normal, see a little bit of inventory loosen up. Obviously, let's continue to the next subject and then we'll finish and we'll talk about inventory and what to expect. But with higher rates, why is this a great thing in your opinion? Talk about opportunity.
Yeah. So one of the things that I want people to hear is I now believe 7% is the psychological number.
Yeah.
If rates tick higher than 7.1 to 7.2, 7.3, we're just going to see demand tighten up. I am not convinced that supply is going to come.
Okay.
If rates go down to 6 in August and September, you're going to see a wave of demand because I see buyers and I talk to agents almost every day. My buyer's not buying with a 7. They're going to buy with a 6. And it will be, 6.9, 6.95, but it will be 6 something. My hope is we have rates above 7 for months. Now that will hurt in the short term. It will, right? I think if rates are above 7 for 3 months, we actually get we break the bottom in transactions. That does not make me feel good for real estate agents or mortgage brokers, but it does long term. So again, our current floor is 4.02 million. We get 7% plus mortgage rates for 90 days. We might see 3.8 million transactions for a month. So that will suck in the short term. But what happens post 90 days? The market will start to heal itself. We will start to find who has to sell versus who wants to sell. And as investors, I can promise you this much. It is far easier to negotiate a great deal from a motivated seller.
Yep.
And if you know creative financing and you have the lending backgrounds of folks that I bring on the channel, you can even pay the seller's price, but structure the deal maybe with a 90% CLTV or combined loan to value, where you get below market interest rates and you get better cash flow. So I look forward to the market slowing down, which will raise days on market, which will give me the Patrick Bet David's ability to write disrespectful offers, and I will find out who has to sell. I mean, for example, people should know if they watch my channel, we were shopping in Las Vegas for a property. Yep. I will talk about the second property that we wrote an offer on. There was this big old palatial place that was dialed in. They bought it for 1.2. They put all this money in. They wanted to sell it at 1.5. Again, I don't have to move. I am willing to wait. So I told that seller I would pay him $1 million cash if they have to sell because it's empty. They live somewhere else. They're paying the mortgage on the property, right?
Yep.
Or I could go get a loan at 1.2. They said no, we'll do it at 1.45 or 1.4. I don't have to buy. So I would only do that deal at 1.2. I'm still tracking that property because I still expect them to come back to me at 1.2 because it's going to be harder and harder for people to get loans. They're going to get tired. They're going to get burnt out. they're either going to turn that thing into a rental, which I can't imagine they would do because it is just cherry, or they're going to have to accept a low ball offer. And the person that has to sell,
Yep.
this is how you find them. You write disrespectful offers. You're patient. You stick to your numbers. Dion, somebody I talk to every Tuesday, got a duplex for 400 when everybody would have paid 500 or 450 or something. You just look for days on market. Days on market could double.
Yep.
In the next 6 months. And I'm going to shoot my shot, my disrespectful offers. So again, as a real estate agent and a mortgage broker, the next 90 days could suck.
Yep.
But coming out of this, we're going to find out who needs to sell versus who has to sell. If you are an investor, I pray you're doing the work, because if you can write creative offers that give the seller their price and you can get your terms to make it a great yield or cash on cash, everybody can win and everybody will happy. Ty, I am ecstatic about higher rates. I hope they stick around for 90 days.
I I love it. I love it. And I want to emphasize too, for realtors out there, for sales, for people, if your bread and butter is selling, listing, representing buyers, the thing I think too right now in this economy, and again, the excitement is if you're adding on new skill sets, if you've been studying buy box, if you've been studying and they're learning creative financing, subject to seller financing, as well as even there's a whole nother skill set of something that we talked about, and it's kind of in between the lines, but not sellers who want to sell, sellers who need to sell. And this is a big deal, Michael, because as an example, more so in the last 3 to 5 years, I almost deal exclusively in probate, estate work, trust work. Now, for the sellers, it's usually found money, meaning that, you know, they're getting a stepped up basis. It's tax free in terms of the transaction. And not only that, but it's unexpected money. It's a windfall, if you will. So the difference of taking a discount because the place is tattered or it's beat up and selling it according to the existing market isn't as emotional. So for realtors out there, I would say now more than ever, you need to put yourself in environments where you are building your skill sets, learning and adding new tools. Also with landlords, burned out landlords, especially in California.
Yeah.
With the prices now potentially, let me ask you this, Michael. Do you believe that we are probably at the summer of 2023 below the median value? Do you see prices stable, or do you think that we maybe, with rates doing what they're going to do, have we maybe peaked out in some markets?
No, below the median. Again, if you divide the market, and again, you got to be very careful with median, right? There's average, there's median, there's all these things. If it's still in every market that I can watch, and I have people from across the country reaching out, there are some exceptions, but not many. Below the median, dude, there's no inventory.
Yep.
And builders aren't building it. So I think if you're still below the median, you're relatively safe. But I got to tell you that luxury,
yeah, right,
not good, not good.
Yeah, I would agree. And I've been kind of like a little bit miffed, like why stuff just above the median, you know, that's not really, it's still cookie cutter subdivision stuff, but selling incredibly well, multiple offers, getting really premiums, but based on low inventory, maybe that market softens up a little bit, I think.
I agree. So, yeah, absolutely. Again, for me, I am really diligent. My ARV, if anything, I'm going to flip is going to come out below the median, not 5%, not 10% over, below the median.
Yep. I love it. Michael, where can people get together with you? I know you've got a special going with the course. Obviously, I think that's coming to an end. Just tell them about the course and what you're doing on the special.
Yeah, so I'll do a couple of things. Again, we talk every week, so we'll keep it going this weekend. How to get started one rental at a time is helping thousands of people get their first and get their next deal. It comes with access to a free Facebook group. That is $3.99 in a stupid value. I will give you $100 in free courses, mastermind, buy box deep dive, found or stuck equity, whatever it is. Look at my website. You can get 2 free courses. So you get $100 in goodies. But the real value is currently in the $7.99 course, which includes 30 minutes of my time. Not only do you get that 30 minutes, you also get the Facebook group. I will give you $450 in free courses. I will give you every course I have for free it just feels to me the right thing to do. I am going to be taking that price from $7.99 to $9.99 and giving the 450 away for free. That's why it's going to $9.99, because if you buy the $9.99, you get all of this. That's just how it's going to be. I won't raise it to $9.99 until I manually go in and add all those free courses to everybody who's already brought it. People who bought the mentoring option, even if they paid less, I want to get everything, because you have been with me, you've been riding with me for this long. So I'm going to be adding that couple, 10 or 20 a day. It takes me time, but once I've added everybody, price is going to $9.99 immediately, because think about that: $7.99, $450 in free goodies, plus 30% of my time, plus Facebook group. It's like almost free. It's crazy.
I want to say, folks, if you have any interest in getting involved, now is the time. And especially 30 minutes of one-on-one time, not in a group. You're going to get 30 minutes with Michael one-on-one, as well as you get all the other bonuses. And that's all going to go away, and or the price goes up. So I want to encourage you, if you have an interest, if you've been sitting on the fence, get involved with the One Reel at a Time community. Michael, thank you for all that you do. Have a great weekend.
Thank you, buddy. I appreciate you.